Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, May 29th, 10:30 a.m. You're tuned into On Trend, the show that is designed to keep you on the right side of the trend. So here's what we're going to talk about today. Trend lines, risk on, risk off. We'll look at Europe. We'll look at that triangle wedge thing in SPY and finish with QQQ. So let's talk about trend lines. What do they actually measure? Now, there are different schools of thought out there when it comes to trend lines. I'm more of the Greg Morris school of thought, in that a slanted trend line basically just measures the rate of ascent with its slope. Nothing more, nothing less. When you break that trend line, the rate of change has changed. In other words, the ascent of the slope, well, you've broken that ascent, but that doesn't mean the trend has actually reversed. All right, you can see here on this chart, we got some examples with some trend line breaks that never came to fruition. And, you know, this is the thing with subjective analysis. You can find examples that work and you can find examples that don't work. All right, it is very subjective, especially if you're drawing trend lines that cut through lows or highs. But I've tried to stick with the lows and the highs, and you know, we've maybe got 3-4 touches here and a break, and that didn't amount to much. And so I drew another trend line, and we've got 3 touches on that and a break, and that didn't amount to much. And then we've got another trend line, 3 touches, and then we got a break, a move back above the break with a gap, but then started zigzagging lower. So that was the trend line break that actually mattered and counted. So you can see here, at best, you have a 1 out of 3 chance of success with a trend line break. Now, I haven't quantified that. I don't think you can quantify trend lines, to tell you the truth. They're very subjective in nature. So here's another way of looking at this AG-Lent chart here, as trend lines telling you a different or a change in momentum. You can see when we had this break here of the green trend line. Excuse me there, I need to go back. So I'm just going to turn my pen back on so I can draw on that to show you those highlights. So there you can see the break, and RSI moved to its lowest level of the year there. So that was a change in momentum, or a dip in momentum. And then when we had the blue trend line break, a little bit after, you had new lows in RSI, lower lows. All right, then we have the purple trend line break, and again we have RSI moving below these prior lows. So this trend line break is telling me you have a dip in momentum, but the trend hasn't necessarily changed. And what's interesting is when we had the big break that ultimately resulted in some extended downside, RSI moved below 30. And what that tells you is you had enough selling pressure to push momentum to oversold conditions. Now, normally that would be a dip within an uptrend, but if you have strong enough momentum to push RSI basically to a 52-week low, that might be a signal that you've had enough selling pressure to reverse that trend. All right, I've got a couple more examples. This is Intuit. And you can see here that we've got the trend line there, and we've got a, one, depending on how liberal you want to be with your touches. If your trend line's not touching enough lows, just make it fatter, and it'll eventually touch those lows. That's kind of a joke there. But we don't draw paper thin, we don't draw trend lines with a thin ink pen. We draw them with a fat crayon or a marker, because they're just kind of giving us an idea of the trend. And there we can see, man, look at that strong break, but it didn't last. We moved right to a new high and moved up. And so that kind of begs the question, well, how do you use trend lines? Do you use them at all? Well, I use them to mark patterns mostly. All right, so here's a pattern, and that's a wedge correction after a sharp advance, and then you got the wedge breakout there. So that's the way I use trend lines, basically. So looking at this Intuit chart and RSI, you can see that we have that break, and then RSI moved below 50 for the first time in months since that trend actually began there. So there's another example of a change in momentum. Here is Illinois Toolworks. All right, and this is just an example of a failed, basically, breakdown, if you will. We have two trend lines, and I drew through this low. You got to be careful because the more lows you draw through, the more subjective your trend line is. But, you know, there's 1, 2, 3 pretty good touches, I think, and then a gap down and a break. And we also broke this other trend line, this green trend line going back to November with 2 or 3 touches. So this looks like a pretty good breakdown. It has to be bearish, a double trend line break and a gap down. But there might be another way to look at that chart pattern, because here's where we were breaking the trend lines. You can see that gap down there. There's where we were breaking the trend lines, but then we got a low there in August. So basically you had the 50-day above the 200-day, the green line. You had a rising 200-day still, and price was above the 200-day, and RSI was flirting with oversold levels, and then RSI got that breakout there in September, and price got the breakout there as well. So this was basically a correction after a strong advance, and that's pretty much the only thing I look for in an uptrend. All right, I'm looking for pullbacks within that uptrend or corrective patterns that I can play. You know, for instance, you could draw some lines there and you would have a bull flag and a breakout. Here you might have a triangle. All right, I'm looking for continuation patterns, not reversals. Here you had a nice flat flag there in October, November, or a pennant. All right, so this is going to be the topic du jour, maybe of the week, because risk off, risk on is rearing its ugly head. And we're going to look at this dynamic using the dollar, gold, the yen, and treasuries, because all 4 of these are kind of like those risk-off assets. In other words, if money moves out of financials and out of commodities and out of stocks, it's usually going to find its way into the yen, treasuries, the gold, and maybe even the dollar. So let's see what's working here. So the biggest thing that we've had happen this year or the past few weeks has been the surge in the dollar. Now I'm going to apply a little hindsight analysis. Hindsight is 20/20, of course. And I admit I did not see this big wedge here when the dollar was trading down below 23.50 in the early part of 2018. All right, I only drew this wedge recently after the breakout. All right, so it's a hindsight pattern, but there's still some value in that pattern. Why? Because you had a huge move here, and this decline here retraced around 61.8% of the prior advance. That's a Fibonacci number. Now, Fibonacci is not so important, but it's, you know, in Dow theory terms, you would expect a 1/3 to 2/3 retracement. And so, you know, that's right around that 60-65% roughly. But you can see we firmed here and we got the breakout, and we've got like a 7% move from the lows there in the dollar. And it's been a very sharp move the last 1, 2, 3, 4, 5, 6 weeks. All right, this is a pretty violent move. Now, it's not quite as violent as this big advance we saw from the middle part of 2014 until the early part of 2015. That was a 25% advance. But the takeaway here is this is a currency shock here, a 25% advance. And the currency markets do not like these kind of shocks. Currency markets like stability. And when you get a currency shock like this, it tells you that there might be something wrong out there, and this can ripple through the financial system and into other markets like equities, which are risk-on assets, basically. And so this big surge in the dollar said, something's not quite right. And the S&P 500 was subsequently flat for 6 to 9 months. All right, it didn't give you a bear market. If you call 14% a bear market, then okay, but this isn't really a bear market. Yeah, it's a downtrend that lasted over 6 months. So right now we're in the midst of a very sharp move. I wouldn't call it the shock just yet, but if we continue to see the dollar moving higher and the euro moving lower, then that could be further negative or impact other markets like stocks. So this next chart we're going to look at here is going to be the euro. All right, because you got to keep in mind currency pairs are like a seesaw. All right, one goes up, the other goes down. The dollar goes up, the euro goes down. That's just the way they work, kind of like interest rates and treasury bonds, which I'll show in a minute. So we saw that the dollar was moving higher and subsequently the euro has moved lower. Now keep in mind that the euro accounts for like 57% of the dollar ETF UUP, more than 50% of the ETF. Plus you got the Swiss franc, which is highly correlated to the euro. You've also got the pound, but the pound is not so correlated to the euro anymore after the Brexit. All right. But what we have here is a big advance throughout 2017 and into 2018. And now we've reversed it. And yeah, I could have drawn some trend lines, but I chose to draw a Roth regression channel. Keep in mind, this is subjective, I admit it. But, you know, we reversed at this 50% retracement. So this looks like a counter trend bounce. And now we've broken down. So it looks like the bigger downtrend is continuing. And I would expect a challenge or a test to these lows. So maybe heading back to parity in the euro. The indicator window shows the German 10-year yield. And we can see that we had a very sharp decline last week. And we've just broken that trend line. And that's a rising wedge. So it looks like yields are heading down. Now, I'm not going to project a move to minus 1% or anything crazy like that. I just think that the decline that we've had in the German 10-year speaks negatively about the German economy or the European economy, because if the economy was strong, yields would be rising in anticipation of tightening from the ECB. But the fact that yields are moving down shows you that there's something not quite right there. All right, and that might be rattling the markets, in particular in Europe. All right, so here is the yen. Now, the yen is known as a safe haven currency. All right, you just go Google it and read all about it. It's a complicated issue, but you can see that it proved itself last week because the yen had a pretty sharp advance. The euro declined, but look at the yen rising. And I have a subjective trend line and a subjective support level there at 86. But you can see that we have a higher low, and this could be another higher low. And we could be headed higher for the yen. And there you can see the Japanese 10-year yield has gone nowhere. Nothing new to report here. Much lower than the other yields, much lower than the German yield, the UK yield, and the US yield. And now we come to Treasury bonds. All right, the third leg of our bar stool as far as risk off is concerned. So we have the dollar rising sharply. We have the yen rising. We have basically the euro following yen rising, because this risk off seems to originate in Europe all the time. I don't know why. Don't ask me, even though I'm based in Europe. It just seemed to happen. But we got money moving into bonds, Treasury bonds, TLT, and U.S. Treasury bonds are the ultimate safe haven. If money moves into Treasury bonds, it's because of some sort of risk aversion usually. And you can see we've got this big move up in Treasury bonds last week. In fact, last week's advance was the biggest weekly advance since October here. You can also see a support zone there by the prior lows and we're bouncing off support. So if Treasuries continue higher, that could show more money moving out of risk assets like stocks and into risk-averse assets like Treasury bonds. Note that I'm using an unadjusted price chart here. I've got a underscore before the symbol there in the left-hand side of the chart, and that means I haven't added back in the distributions. All right, this is a buy-sell only based on actual trades. It doesn't have dividends influencing it. All right, so if Treasuries do move higher, that could be positive for bond proxies like utilities and REITs. And if Treasury yields move lower, it could weigh on banks. So what about gold? Now, gold is the fourth leg of this bar stool. And gold, normally you would expect gold to decline if the dollar advances. But last week, both advanced. The dollar and gold were up. So that right there tells you, something's not quite right, because those two are usually negatively correlated. And so if they both rise together, especially two adversaries like the dollar and gold are all of a sudden moving in the same direction, that tells you that something is up. Now, I did some correlations to try and find, a good relationship that proved this point, but admittedly it was pretty hard to do. I would have to really data mine and really search for an example. But I think just on the face of it, the fact that gold and the dollar rose tells you something's going on. Now, if we look at this gold chart, I would have to say the big trend is up. All right. And why is that? Well, you can see that you've been advancing there since December 2016. And you've got higher lows here. You've got higher highs. So we've got, an uptrend there. We've come down, and this might be a higher low forming because it's above this low. And look, RSI moved back above 30. So basically, you can see that you have an uptrend, and the prior two lows, RSI moved below 30 to become short-term oversold and bounce back up. And that was a good entry point. And we got the same thing happening here. All right, so this means that, if you play the mean reversion side of the markets, this is the mean reversion setup. You've got the bigger trend is up, and you became oversold with that sharp decline the previous week, and then last week you firmed and RSI moved above 30. So this is possibly an opportunity for gold. Now, how it interacts with the dollar and all that is to be seen, but if you see gold and the dollar move sharply higher the next few days, that would be a pretty risk-off sign for the markets. All right, so what is pushing money out of the euro? Well, it could be the fact that we've seen a very sharp decline in Italy over the past 3 weeks, a sharp decline in Spain. I'm talking about stocks over the last 2 weeks. So we'll look at those, and I'll show you how to find international index symbols. And for that, we're going to go to the StockCharts website. All right, so I've got a chart here that has some Dow Jones International Stock Indexes. And these are great if you want to compare a number of different country stock indexes. Now, as many of you know, we had to stop doing the FTSE and the $MIB, the FTSE Italian Milan Index. And that is because of some charging issues that the FTSE Russell company wanted to us to pass on to our users. And so it just wasn't economically feasible to carry those indexes. But the alternative would be these Dow Jones indexes, and I'll show you how to find those here in a minute. But first of all, I've got the Germany index at the top, and you can see that a potential lower high is forming. And look at that, right at that 62% retracement. So this one kind of looks like the S&P 500 in that it had a nice rally, but now we got a potential lower high and a breakdown on our hands. So if Germany moves lower, that's basically the economic engine of Europe. I would consider that negative for Europe. Now, France is hitting a 52-week high, so there's no problems with this index. All right, but then we look at Italy. All right, Italy is down around 9% in the last 3 weeks. It's down again today, below the 200-day. These other two breaks didn't amount to anything, but this one may be the one that breaks the camel's back. All right, this is after a 52-week high, mind you. Everything was hunky-dory in early May, but now we're breaking down in Italy. So this is an issue. Then we look at Spain. Spain continues in a long-term downtrend. All right, it looked like it was trying to turn the corner there in January, but then fell to new lows. And then had a counter trend bounce here in April and into May, and down over 4% the last 2 weeks. So a long-term downtrend for Spain. So those are the two weak points in Europe, Spain and Italy. And then I just threw in Portugal there. It did hit a 52-week high in mid-May, but fell around 3% the last few days. So Portugal is weighing. So how do we find these symbols for these Dow Jones stock indexes? Well, at the top of every web page, you have that search icon, the little hourglass or the little magnifying glass there. And if you click on that and you type in Dow and Jones and stock and index, like I've just done, and you click search, you will come to our search criteria page, and it'll see showing you support articles, but that's not what we want. Well, maybe you do, but I'm looking for symbols. So I'll change that to symbols, and it'll refresh, and there you can see all the international stock indexes from Dow Jones. And I like to use these for an assessment of the actual country because it's based on local currency terms. Okay, it's not like a US ETF, which has a currency conversion where you would take, say, the euro and convert it to dollars and then price the US ETF. So there's that currency component in the US ETF. But if you want a pure, cleaner estimate of how that country's stock market is doing, then you need to look at this kind of stock index. And since we don't carry the FTSE or the Italian MIB, you can get it here from the Dow Jones indexes. So now we have the triangle versus the wedge versus the flag for SPY. And this is very important because whatever happens to SPY is probably going to happen to most of the other indexes, sectors, industry groups, and stocks in the stock market. Because SPY is the main driver, the S&P 500. I know everybody's been talking about how the surge in the dollar is helping small caps. Well, that surge in the dollar is not going to help small caps at all if the S&P 500 turns down. In fact, if the S&P 500 turns down, small caps are probably going to lead on the way down. So the bigger thing to watch would be the S&P 500 when it comes to small, large instead of the dollar, I think. So if we look at this chart here, we can see that the S&P 500 is broken out of its triangle and then stalled. So the base case was long-term trend is up, 52-week high, 50-day EMA is above 200-day EMA, 200-day EMA is rising and price is above it. That's the long-term uptrend. Then the blue lines show the big triangle consolidation. All right, so I'm using these to mark the pattern. All right, we broke out of the pattern. This is not a hard resistance level. It's a subjective resistance level. We did break above this high here in April, and then we just stalled. All right, so this could be a flat flag. And if we break 275, then we continue higher and everything is fine. All right, but we've seen, as I showed before, that new highs on the S&P 500 are really dragging. We're not getting a lot of leadership within the S&P 500, and that is a big concern. All right, so we have to think about other possibilities other than this triangle breakout. So let's break this down a little bit and look at it in a different way. So now I've got a chart showing close-only prices, and I really like to do this sometimes. Start with just a clean slate, close-only prices, and then see what you see. All right, well, first of all, you know that the S&P Small Cap 600 hit a 52-week high here in the latter part of May. Well, the S&P 500, SPDR, SPY didn't even make it above its March high. All right, not to mention didn't even come close to that January high. All right, so that's a negative. And then you can see we had a wedge and a breakdown in February, March. We've got another wedge, And look at the steepness of the advance here on the previous wedge, very sharp. That's probably because of the sharpness of this decline here in January, February. But this is not a strong amount of, this is not strength really. Yeah, you got a nice surge here and the surge is holding, but if we break below 270, then we have to entertain the idea that this is a bearish wedge. All right, and we could break down further and be set for a test of these 2018 lows. All right, that's the bearish argument out there, is that this is a bearish wedge. And if we close below 270, then I would bring that argument to the forefront and put that triangle back on the back burner. All right, let's look at the swings within this big triangle that we've got, because the swings are more important than ever, I think. And, you know, it's been, first we started with this massive downswing to start the year, basically. All right, January, February. And all the other swings have been contained within the prior swing, basically. Swings are getting shorter and shorter. But then we got this breakout here and things were looking good. And we got a consolidation. And normally we should break out and continue higher. But if what normally is supposed to happen doesn't happen, you have to question your thesis. In other words, if we break down at 270 here, the upswing would reverse and we would have a new downswing, and that bigger wedge would come in play. And so that's what we need to watch for. Now I put MACD on the window here, on the indicator window, but to tell you the truth, do you need an indicator on this chart? No, we don't need an indicator on this chart. Do we need volume? No, we don't need volume on this chart. This price action is telling us all we need to know. And that's why I use indicators sparingly and I use volume almost never, especially for an ETF. I never use volume for an ETF. Maybe for an individual stock, but never for an exchange. And I'll get into that argument one day maybe. But basically, you know, if you want to use MACD, you can see it's just above its signal line and if it crosses below. But if you see with a lot of indicators, you're going to get the signal a couple days after the breakdown. All right, the indicators are going to be lagging what you're seeing on the price chart. And, you know, SPY or the S&P 500 is a price chart that everybody interested in the stock market should be looking at and studying every day. That's the one chart you really need to focus on because it is the market. All right, so I've only got about a minute and a half here, so I'm just going to quickly run through on the charts, QQQ, some top tech ETFs, XLF and XLV. All right, so here is QQQ, and the big trend is up. There's that big surge, and it looked like we were getting a pennant breakout last week, but this may be failing, so we're going to watch 167 for a support break that would reverse this upswing here. When we look at the top stocks in QQQ, we can see Facebook might be forming a lower high, so we're watching support here from these mid-May lows. Google gapped down in mid-May and never recovered, so it's looking weaker than the rest of the group. We can see Apple is stalling with a high and tight consolidation. Again, watch those mid-May lows for a break that would call for a pullback. Amazon, same thing, stalling at a high level. I mean, these charts aren't by any means long-term bearish, but if you get these short-term support breaks, that would add credence that we're going to get a pullback in the market. And Microsoft is the strongest of all of them because it hit a 52-week high intraday on Friday. Now, financials are a concern for the broader market because we got that pop for 3 days and then a drop last week. So I thought we had a flag breakout out, but it failed and we moved lower. And if Treasury yields move lower, financials could also test this support here. So healthcare is still one of the biggest sectors in the S&P 500, so we need to watch it. And you can see it's at a moment of truth here with resistance. Had the big surge and the pennant. If you break out at 84, bullish. But if you break down here, that keeps it in the longer or the 2018 downtrend.